All right, let's talk about a word you've probably heard thrown around in finance, a word that sounds kind of complicated: derivatives. They have this reputation for being super complex, right? But what if I told you the whole idea started with something as simple as a farmer trying to get a fair price for his wheat? Today, we're going to peel back the layers on all of it. So here's our game plan. First, we'll nail down what a derivative even is. Then, we'll look at how the first ones came to be and how they evolved. After that, we dive into the really cool stuff: options, what they are, what they're made of, and how they actually get their value. Okay, first things first. What in the world is a derivative? It sounds like something from a crazy math class. But honestly, the clue is right there in the name. It all comes down to where it derives its value from. See, a derivative isn't a thing you can actually hold in your hand. It's not a stock certificate or a gold bar. It's just a contract, an agreement between two people. And the value of that agreement is completely tied to the value of something else, what we call an underlying asset. And that something else can be pretty much anything that has a price that moves around. We're talking stocks, bonds, commodities like wheat or gold, even things you can't touch, like currency exchange rates, interest rates, or the value of an entire market index like the Nifty or Sensex. So now that we have the theory down, let's see how this all got started. You might be surprised that this whole world of high finance was actually born from a very real, very down-to-earth problem. Let's imagine a farmer. We'll call him Mr. Singh. He's out there planting his wheat crop. But here's the thing. He won't get to sell it for months until it's time to harvest. And his biggest fear? What if by then the price of wheat totally crashes? All that hard work for nothing? So to protect himself, he makes a private deal, a handshake agreement with a buyer. They agree on a price right now for the wheat he'll deliver in the future. This is called a forward contract. He's totally eliminated his risk, which is great, but he's also given up the chance to cash in if wheat prices happen to go through the roof. He's basically traded a gamble for a sure thing. But this simple handshake deal has some big problems. I mean, what if the buyer just disappears or goes bankrupt and can't pay him? That's what we call counterparty risk. And because this contract is custom-made just for him, he can't just turn around and sell it to somebody else if he needs to. It's illiquid. And this is exactly why futures contracts were invented. They're designed to solve all those problems. You can think of a future as a standardized, publicly traded version of that private handshake. They trade on an exchange, which guarantees the deal, so there's no risk of the other person backing out. And because every contract is the same, they're super easy to buy and sell. Okay, so we've gone from a private promise to a public, regulated market. But forwards and futures are both about obligation. Both people are locked into the deal no matter what. The next leap forward in finance was a totally radical idea. What if you could have the choice to act without being forced to? And that is the absolute magic of an option. It gives the person who buys it a right, but crucially, not an obligation. That's everything. It means you have the power to make the deal, but you can also just walk away if it's not a good deal for you anymore. What's so fascinating here is how lopsided it is. With a future, the risk is pretty much equal for both people. But with an option, the buyer pays a fee that's called the premium for that incredible power of choice. And this means the most the buyer can ever lose is the premium they paid up front. Their risk is capped. The seller, on the other hand, is taking on a much bigger risk for the chance to collect that premium. All right, so to really get how these things work, we got to know the basic lingo. Let's break down the three most important pieces of an option. First up, the call option. This gives you the right, but not the obligation, to buy something at a set price. A really easy way to remember this is that you are calling the asset to come to you. You'd buy a call if you think the price of something is going to go up. It's a bet on the upside. And on the flip side, you've got the put option. This gives you the right to sell something at a set price. You can think of it as you have the right to put your asset onto someone else. You'd buy a put if you think the price is going to go down. It's a bet on a drop. And finally, the strike price. This is the magic number. It's the fixed, pre-agreed upon price in the contract. It's the price at which you get to buy or sell. No matter how wild the market gets, the strike price is your anchor. The whole deal revolves around this one number. So the big questions are, how do you know if an option is a good deal? And what does this incredible power, this right without an obligation, actually cost? Well, that amazing flexibility to walk away from a bad deal, it's not free.
The price you pay to get into the game, the cost of the option contract itself, is called the premium. The buyer pays it to the seller to get that right.
Okay, so how do we talk about an option's value, like right now? We use a concept called moneyness. I know, it's a weird-sounding word, but it's actually just a simple way to describe whether your option would make you money if you used it this very second. Let me show you what I mean.
Let's use a super simple example to make this crystal clear. Imagine there's a stock, and it's trading right now for exactly $100 a share. And you're looking at a call option, so that's the right to buy that stock.
Okay, if your call option has a strike price of $90, we say it's in the money. Why? Because you have the right to buy a $100 stock for only 90 bucks. That's an instant $10 profit right there. It has real immediate value. But if your strike price is $110, it's out of the money. Think about it. Why would you ever use your right to buy a $100 stock for 110? You wouldn't. That option has no immediate value, but, and this is key, it's not worthless. There's still time for the stock price to maybe shoot past 110. And all this brings us to a final, really big question. From a farmer just trying to lock in a price to a massive company trying to protect itself from currency swings, derivatives can be incredibly powerful tools for managing risk. But they can also be used to make huge, high-stakes bets on which way the market will go. So, are they essential tools or just a sophisticated casino? The answer is kind of both. The tool itself is neutral. How it's used is what really matters.